Like and subscribe to my channel and click the bell icon to get new video updates.
Analysis. The next ESG frontier is genetically modified food. The need to feed a growing population while reducing high levels of greenhouse gas emissions from agriculture means farming must become more efficient. Increasing the use of genetic engineering in seed production is one solution. Yet GMOs remain for many ESG funds. Bogeymen fearing the unintended consequences of interfering with the food chain. However, countering this is a strong social consideration. According to analysts at UBS Group AG, global crop demand in 2050 is projected to be 61% higher than in 2020. While the one's crop yields have improved, those gains would need to be accelerated to prevent crop supply shortages, possibly as early as the turn of the decade. UBS calculates. Without such improvements, the research finds, the additional farmland needed to meet demand is equal to the combined land area of the Union 10 Kingdom, France, Belgium and the Netherlands. There would be enough crops, but no reforestation. Therefore, efforts to promote biodiversity would suffer. Activists are looking for stocks trading below perceived fair value with identifiable catalysts to close the gap. Bayer's market valuation suffers a significant discount to Corteva, even considering that half of its business is in pharmaceuticals. The apparent triggers for the closure of the rebate are a pivotal settlement of a lawsuit alleging that herbicides containing glyphosate cause cancer, management change, and the listing of a stake in the crop science business to attract investors who may be put off by Bayer's conglomerate structure. But in addition to these traditional value drivers, there is a possibility that ESG attitudes towards the crop science sector could change radically. Changes. For some ESG funds and indices, companies that derive more than a fraction of their sales from genetically modified organisms are taboo, as are companies involved in tobacco, gambling and nuclear weapons. Emissions from food production become part of the corporate and investor conversation. French dairy giant NNSA announced last month that it is targeting a 30% reduction in methane emissions from its fresh milk supply chain by 2030. Others will come under pressure to make similar commitments. Index provider MSCI Incorporated changed its ESG exclusion criteria last year, with the result that companies involved in GMOs are now less likely to receive a red flag. Analysts also point out that because GE involves altering a plant's DNA without introducing a foreign gene, as with GMOs, so-called gene editing may be more acceptable to the public and regulators than genetic modification.